Well, the incoming Trump administration's policies may mean the Fed will not be able to avoid addressing the impact of fiscal policy. Yahoo Finance's Julie Hyman is here now with a closer look at the shift here. Hey, Julie.
Yeah, data dependent. That's been the buzzword for the Fed for a long while now. It might have to switch to fiscal policy dependent in 2025. And Jay Powell, of course, the Fed chair, he has been very adamant at many press conferences, both across the first Trump presidency, the Biden presidency, and now sort of looking ahead to Trump 2.0. He's been adamant that the Fed's job is to focus on monetary policy, to focus on its dual mandate of price stability and full employment, and not to sort of directly address fiscal policy. I mean, in the latest press conference that he gave, he talked, which was just a few days after the election, he said, we don't comment on fiscal policy. We're not going to talk about the election. But in the next year, the Fed might have to factor in that fiscal policy and then its effects on the economy. Well, why? Because we are seeing a potential fiscal policy that could be more inflationary. We talked to Torsten Slok of Apollo this week, and he laid out some of the reasons why.
What might be coming next year is that if the main three areas where new policies might be coming is lower taxes, more tariffs, restrictions on immigration, it happens to be the case that the textbook would be predicting that all those things should be putting upward pressure on inflation.
Of course, the textbook doesn't tell us what will actually happen. And the problem is around all of those issues, we don't know how they're going to play out. Will there be mass deportations or will they be more targeted? And even when you talk about immigration, there are both puts and takes when it comes to the effects on inflation, because more immigration can also cause an increase in demand for things like housing. When you talk about tariffs, will they actually be imposed across the board? On what countries? At what rate? Or will they be a bargaining chip? And then, of course, for tax cuts, will they be extended? Will there be deeper tax cuts? Will they be targeted at various areas? So all of these ways could affect the economy, and the Fed is going to have to address that. And then if you look at the backdrop that the Fed is dealing with here, we're looking at an inflationary environment that has effectively stalled. We learned that this week. We got a PPI reading that came in larger than estimated at 3.4% on a core basis, which is what the Fed typically looks at. That's wholesale inflation. Consumer inflation still holding steady at 3.3%. And then the PCE, core PCE, which is what the Fed really zeroes in on. We don't have last month's reading as of yet, but we'll get it. But the latest reading we had was 2.8%. The Fed's target is 2%. So Brad, put all of this together. You have this backdrop where inflation is just kind of stalling out. It's not coming down to that last little bit to 2%. Yeah. You have all this fiscal policy uncertainty. Jay Powell might not want to talk about it, but obviously the Fed is going to have to factor in some of this stuff.
Yeah, absolutely. And we'll see exactly what the makeup of the FOMC going forward, even after Jay Powell, his term ends 2026. So he's still going to have to navigate through the first Trump year. And then even in the second Trump year, you're going to have a lot of talk about what that makeup for the FOMC could look like. Julie, thanks so much.
Thanks,
appreciate it.